Hi, Greg Weldon here. We're about to record Weldon Live, so I thought I'd kind of give you a little behind the scenes in terms of what happens going into making one of the Weldon Lives. The PDF is loaded here, all the charts are in, all the text is in, all the data's in, our synopsis is in. Let me get you a look at that real quick in terms of our synopsis. I know it's kind of tough trying to get the technology here where I'll be able to cut to the screen and back and forth and so on. But anyway, we're just going to kind of kick into it, and this is actually the recording we're going to do for today, so we'll let you listen in for a minute or two. Hi, Greg Weldon here with Weldon Live for Thursday, May 24th, and today we bring you a very special Weldon Live. It's a focus on the energy market. We look at the fundamental supply-demand data. We look at the weekly data in the U.S. We look at the most recent OPEC monthly oil market report. Some really interesting stuff there in terms of the supply versus the demand, the non-OPEC versus the OPEC cuts versus increased U.S. production versus, basically when you shake it all out, okay, throwing away some of the wild cards still, like Venezuela and Libya and even Nigeria. Really, it comes down to something this simple, where you have 1.2 million in production cuts still in effect from OPEC, 300,000 from Russia. Okay, so in total, you're talking about, and another 300,000 in other non-OPEC. So you're talking roughly 1.8 million in cuts. If you take the non-OPEC production for 2017, including Russia, you actually are looking at 1.7 million barrel per day increase in output. Okay, and that plays off against the 1.65 million barrel per day increase in global demand, according to OPEC's figures. So they cancel each other out. And at the end of the day, you see U.S. inventories declining despite the rise in production because the OPEC cuts do matter. It's the swing factor right there. That 1.2 million barrels per day is the swing factor. That's why inventories in the U.S. have fallen despite the fact that production has risen. Now the question is, are things shifting here? Then we tie in the speculative long position, which is significant. And frankly, you could be looking at, let alone the dollar rally, and you could be looking at a situation here where, crude and gasoline are very much at risk of a downside corrective move. We've been bullish. We're long gasoline. It's been a phenomenal trade. Two different instances from $1.54 to $2.03 between September of last year and February, and now again we're long at $2 and the last price at $2.24.25. We're stopping at $2.21 now on this long position. We want to take profits. We don't want to let this thing get away from us too much. Gasoline, the position dynamic is even more acute than it is in crude oil. It's the largest ever, both in terms of managed money and the COT report, which shows us large speculators. Both are at record highs in terms of the long exposure. So we still like it longer term. The fundamentals, particularly in gasoline, better than crude. And then we tie it into the XLE and the frac and our position in the U.S. energy sector, which frankly benefits from all of this with huge demand and with huge investment, having knocked down well costs, having knocked down really the break-even rate to where these companies should be looking more and more profitable going forward. ExxonMobil, of course, is the key. We focus on that here today, so now we're no longer doing the live because it would be too long, but we're giving you an idea, and here's a preview of today's live, our special focus on energy. You want to see why we think what we think here? It's mostly fact-based. Check it out. Email me directly, and we'll get you on trial here for the research that pays for itself. We have trades in every sector, and we have documented track record of calling the big moves in the markets really going back over 2 decades. I've been doing this in terms of publishing independent research. So I got to get back to the Weldon Live. I got to get starting all over here again. But if you want to check it out, today's Weldon Live as it relates to energy, I got emerging markets coming up as well. We also did a big piece on the U.S. yesterday in terms of the Federal Reserve surveys and a rise in prices received and a big jump in wages and how does that affect the bond market, the dollar, and the stock market, which in the U.S. still looks very vulnerable to me, particularly the S&P at 2,700. As we also note, the weakness in Europe, and we've been all over the BTP situation, the Italian bonds, one of our bigger trades already this month in just a few days. So again, signing off, back to the Weldon Live. Email me directly, Greg Weldon, GregWeldon, Greg Weldon at weldononline.com, and I will set you up for a free trial to my daily research service.